Generating exactly $96.6 billion in annual free cash flow, one tech titan functions like a sovereign financial entity. Yet Wall Street is ignoring the underlying structural vulnerabilities that might just hand the ultimate victory to its smaller rival. But does this unmatched financial firepower guarantee total market dominance, or is a hidden structural trap waiting to wipe out those gains? When you look at the explosive $68.1 billion in fourth-quarter revenue delivered by NVIDIA, you must immediately contrast it with AMD reporting a highly respectable, yet vastly smaller $10.25 billion. At first glance, with NVIDIA experiencing a 73% year-over-year revenue surge and AMD pushing a solid 38% increase, the financial media calls this a straightforward victory for scale. But the ultimate winner looks much more complex. NVIDIA's phenomenal top-line explosion proves they are ruthlessly defining the absolute boundaries of the data center accelerator market. Meanwhile, AMD's impressive $10.25 billion proves they are successfully carving out guaranteed foundational demand pipelines. The golden rule for your portfolio here is that true value investing requires understanding massive total addressable market expansion, not just staring at nominal revenue gaps. This brings us to the sheer profitability chasm between these two silicon titans. While NVIDIA boasts a staggering 75% gross margin, AMD is trailing significantly with a 53% gross margin. Think of gross margin as the basic markup a company earns before paying operating expenses, acting as the ultimate measure of pricing power. Most stock market analysis assumes one company simply builds better chips to earn that 75% margin. But the competitive twist lies in the true source of that pricing power. NVIDIA's towering 75% margin indicates a total, inescapable ecosystem lock-in, where clients gladly pay a suffocating premium for proprietary software synergy. Conversely, AMD's 53% margin reflects the brutal reality of a high-performance hardware challenger fighting tooth and nail for raw market share. For your portfolio, this divergence in fundamental analysis means you are comparing a sprawling software monopoly with a lean hardware alternative. To grasp why this profitability gap matters, we must look at an even more punishing metric, which is operational efficiency. NVIDIA converts every single dollar of sales into a 65% operating margin, whereas AMD currently operates at a much tighter 14.4% margin. Operating margin reveals exactly how much profit remains after paying daily operations, proving how efficiently a business scales. When you compare NVIDIA's colossal $44.3 billion in quarterly operating income against AMD's $1.48 billion, the structural reality bites hard. NVIDIA's entrenched infrastructure allows nearly every incremental revenue dollar to drop directly to the bottom line, securing that 65% yield. Meanwhile, AMD is forced to absorb massive costs to expand its global footprint, perfectly explaining its leaner 14.4% yield. As an investor, you must always evaluate a company's operating leverage, because sheer top-line growth means nothing if the business bleeds capital while scaling. This leverage dictates the ultimate financial weapon, which is cash flow. We already established NVIDIA's $96.6 billion in annual free cash flow, which dwarfs the $2.57 billion in quarterly free cash flow generated by AMD. Free cash flow is the pure cash left over after a company pays operating expenses and capital investments, acting as the ultimate corporate war chest. Look at the innovation sprint driving this industry. NVIDIA poured an eye-watering $18.5 billion into research and development over the year, while AMD maintained a focused, yet smaller $2.4 billion quarterly research engine. Furthermore, NVIDIA utilized a massive $13 billion cash outflow directed at an external target, signaling a predatory willingness to aggressively buy into emerging technological niches. AMD simply lacks this reckless, inorganic luxury with its $2.57 billion in quarterly cash. This financial divergence proves that capital intensity is the ultimate competitive moat. Before assuming this dominance is bulletproof, a hidden plot twist lurking on the balance sheet threatens this entire narrative. NVIDIA is currently hoarding $21.4 billion in total inventory, reflecting a massive 112% year-over-year spike, while AMD holds a much more proportional $8.04 billion in inventory. The market blindly cheers inventory buildups as guaranteed future sales, but when NVIDIA's massive 112% inventory surge outpaces its 65% full-year revenue growth, while AMD keeps its $8.04 billion stockpile aligned with its guided 46% revenue jump, a dangerous vulnerability emerges. If hyperscaler capital expenditure budgets suddenly cool due to unforeseen economic slowdowns, NVIDIA faces a multi-billion-dollar write-down risk that could crush margins overnight. This is exactly why fundamental analysis requires looking past surface growth to the underlying quality of the balance sheet, ensuring you do not walk into a cyclical supply glut. The entire digital infrastructure boom is being funded purely by explosive organic cash generation, avoiding precarious leverage. Where they diverge sharply is in how they choose to return that capital to shareholders. NVIDIA deployed $40.1 billion in share repurchases, acting like a mature value stock, while AMD executed a modest $221 million in buybacks to prioritize internal reinvestment. The investing strategy is vital. You must align your investment timeline with the corporate maturity phase, choosing between aggressive shareholder yields backed by $40.1 billion or relentless capital deployment. But to understand the trajectory of these titans, we must look at where this capital is going and the geographic barriers standing in the way. NVIDIA has been forced by shifting global policy to project $0 in data center compute revenue from major international markets, effectively severing a massive geographic artery. In stark contrast, AMD is rapidly expanding sovereign infrastructure deals globally by securing a 6.0 gigawatt deployment partnership with major domestic hyperscalers. Market optimists claim that international regulatory friction resulting in $0 of regional revenue is irrelevant. But when you observe AMD securing that massive 6-gigawatt footprint specifically to prevent a total NVIDIA monopoly, the dominant narrative fractures. NVIDIA's geographic concentration is a severe structural vulnerability, forcing total reliance on a shrinking pool of allied hyperscalers. The market will always fund a highly capable secondary supplier, virtually guaranteeing AMD's long-term market share regardless of NVIDIA's dominance. And this brings us to the final hidden pressure point that could unravel the euphoria across the broader technology sector. NVIDIA's accounts receivable has swelled to $38.5 billion, demanding immediate attention when directly compared to AMD's hyper-efficient collections that provided a $280 million operating cash benefit. Accounts receivable represents money owed by customers for goods already delivered, meaning it is paper profit, not actual cash. Most stock market analysis ignores ballooning receivables during a structural boom. But with $38.5 billion securely tied up in uncollected revenue, NVIDIA's immediate short-term liquidity heavily depends on the prompt, flawless settlement behavior of its largest enterprise clients. If a sudden market volatility event throttles those hyperscaler clients, that magnificent paper revenue rapidly becomes trapped, highly illiquid capital. This teaches us a timeless investing strategy, reminding us that you must never confuse recognized revenue with actual cash sitting safely in the bank. We started our analysis by asking if unmatched financial firepower guarantees total dominance, or if hidden structural traps await the unsuspecting buyer. The answer lies in the reality that NVIDIA's 75% gross margin proves it has successfully insulated itself from brutal hardware commoditization through a proprietary software ecosystem. Meanwhile, AMD has secured its permanent position as the essential alternative supplier with its impressive 38% top-line revenue growth. The ultimate truth is that NVIDIA is no longer just a traditional hardware company. It is the gravitational center of an entirely new digital economy. But its $21.4 billion inventory and extreme enterprise client concentration make it highly vulnerable to any sudden contraction in global infrastructure spending. AMD, with its exceptionally lean efficiency, operates as the vastly safer cyclical hedge against that exact monopoly risk. That's why I believe that within the next 24 months, the market will abruptly reprice these tech titans, forcing a historic rotation back into deeply undervalued alternative hardware providers, which is the essence of value investing. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that, noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.